Welcome to the latest Insights video with Clare and Storm of the Global Innovation team. Clare, can we start with software? We saw quite a sell-off a little while ago, and you talk about the transition of software. Can you explain what you mean and what your view of that sell-off is?
What we're seeing play out in the market is a recognition that software is being re-architected. We're moving from software 1.0 to software 2.0. Software 1.0 is what we all use every single day. Hundreds and thousands of lines of code that instruct a computer how to act in every given situation. And this is run on traditional compute, CPUs. Software 2.0 is fundamentally different. An AI model is infused into the software itself, and it's capable of deciding the best course of action. The unit of compute there is the GPU, so NVIDIA, not the CPU, and the underlying operating system, instead of Microsoft, is actually the model itself. Now, the outcome of this is that the marginal cost of producing software is heading to zero, and that changes everything about how investors should be valuing the sector.
And where do we go from here then, Storm? Is AI eating software?
Yeah, so what we learned in July last year is that AI is now generating genuine value across the economy, which has really hit an inflection point for the industry, is attracting a lot of capital into the space, which I'm sure all of our clients are very well aware of at this particular point. Now, what we need from this point forward is we need more infrastructure. So we're infrastructure constrained, and what we're hearing in addition to that is a number of products being launched almost every week now from companies like Anthropic, OpenAI, and so on. And to what Clare was just talking about, software 2.0, it's very quick to build new products in software 2.0 because the human's out of the loop. And so machines writing code for machines rather than, say, 60,000 software developers sitting in Microsoft HQ, building industrialized software. So we expect, as Clare talked about, the bloodbath in the software market, we expect it to persist. That has not priced in yet. These companies have got genuine competition for the first time by much cheaper, much more agile and easier to develop products. These products that are coming to market like Cowork, like OpenClaw, we're expecting a number of products to be launched in the next 2 weeks. This is the start of a range of new products coming to market that will have significant impacts on the global economy and current competitive dynamics across industries.
And Clare, one of the persistent questions is, are we now seeing a return on investment from this AI spend?
Yeah, Simon, so it can't be simultaneously true that AI is eating software and we aren't seeing an ROI on AI. That's the reason that we're seeing a $2 trillion wipeout in the SaaS market. Anthropic is probably our clearest proof point to date. So this company didn't exist as a revenue-generating company 3 years ago. In 2024, they posted $1 billion in annualized revenue. That grew to $10 billion in 2025, 10x growth year on year. This is the fastest enterprise software ramp we've really ever seen as investors. But more importantly, they swung from negative 95% gross margins last year to plus 40% gross margins this year. And that tells you everything about what happens when inference scales. The cost of developing marginal intelligence doesn't just fall, it collapses. So we're definitely seeing an ROI on AI. The trouble is that the market's looking for this ROI in the wrong area. They're looking for it in traditional software companies. We're seeing very strong ROI from Anthropic and OpenAI, obviously private companies. We are seeing an ROI on AI come through in public markets for software 2.0 winners. So Meta is a very good example of this, seeing a 22% uplift in return on ad spend for their advertising customers based on AI model enhancements. Spotify is another good example. Their developers, or their best developers, haven't written a single line of code since December.
Just want to pick up on the market. So the market appears quite calm, but we've had a huge amount of volatility between sectors, between individual stocks. And we've had some companies with data, digital, that have actually been hit quite hard, where the market thinks they'll be losers rather than winners. How are you kind of navigating this? What's this telling you?
Well, the disruptive impact from AI is real. And we're just starting to see the early signs of that impact across companies, the global economy. We're using this technology, all the time. And in particular, the breakthrough from 6-8 weeks ago with co-work, with all the APIs that plug in across lots of different industries, like it's now become table stakes. And so it started off an arms race between the US and China, and now it's table stakes across the enterprise because the tools are now doing jobs for you in ways where you're uncompetitive, you don't keep up. So what does that mean from an investor point of view? Both the incumbent companies across different stock markets, from the UK to the US to Europe. Well, to be a leader over the last 20 years, it's taken a certain sort of type of product or service into the market with barriers to competition, high returns on invested capital. We would argue that that's not the right place to be. The right place to be is in the companies that we expect to lead the next cycle. So a changing of the guard, so to speak. And these companies are just very, very different to the past. And that's because we're entering into a different type of competitive dynamics across the global economy where, unique data sets are no longer, the picks and shovels across the economy. And you can no longer charge what you want for those particular data sets. What we're seeing is a shift in the value across the economy move down into the physical infrastructure layer. So digital moats are no longer barriers to competition like they used to be. We have got new competitors coming to market. We're not buy and hold, we're active because stock prices are moving around a lot. There's a lot of fear in the market of just selling certain areas of the market. And we've got strong conviction about where we're going over the next 5 years. And so that enables us to build into some of these positions where the baby's been thrown out with the bathwater. But it's also, when you get this level of stock dispersion, you've got you've got fear, and the second, you've also got competitive dynamics being reshaped in real time. And so from our perspective, that produces a good opportunity for active fund management.
And you talked about the type of companies that will be the winners of the future. Is it quite clear who the individual companies will be?
It's becoming more clear, and certainly the market is in the process of sorting out those that are going to be on the right side of this transition and to those who aren't. And what we're doing is we're going through all of our holdings and reassessing the moats. As Storm said, we're looking for physical moats. Agentic AI doesn't care about company lock-in switching costs. These data moats no longer holds. So whether that manifests itself in a physical distribution network like Mercado Libre's, whether that is investing in the actual silicon layer and the silicon equipment companies like NVIDIA or KLA, those are the types of companies that we're focused on because those moats persist. In fact, they actually become a scarce resource going forward.
And data centers, what does this all mean for data centers? This is still a big topic of the build out.
Sure. So the transition from software 1.0 to software 2.0 has significant implications for the data center build out, and we think this is still being dramatically underappreciated by the market. So we're looking at a $3 to $4 trillion addressable market by 2030. We actually think that could be conservative. And there are three scaling laws driving this to understand this. First, you've got pre-training. So more data and more compute, training better models. Broad rule of thumb is if you 10x the compute, you throw out a model, you double its intelligence. So that carries on. You then are post-training these models to become industry specialists. But most important is that we're seeing inference time scaling really take off. This is reasoning. And models thinking through problems step by step consumes around 100 times more compute per query. So compute demand is going only one way. It's going vertical. We're in a supply-constrained environment, we believe, through the end of this decade. What we think is most misunderstood by the market is that this data center CapEx addressable market is actually three distinct total addressable markets. So first of all, you've got the transition from traditional compute to accelerated compute, moving from CPU workloads to GPU workloads. That's already happening because accelerated compute is 100 times faster, 98% cheaper than traditional compute. You can see this in the hyperscalers today. You then got the model training, which is where the market focuses. This is OpenAI and Anthropic training their frontier model labs. But this is only one market. And then finally, you've got inferencing. And that's the part that's growing the most rapidly and is still being underestimated by the market because every agential query every API call, you're increasing your compute demands by 100-fold each time.
You mentioned physical AI. That's obviously a key area that you see of growth going forward.
Yeah, so the transition from software 1.0 to software 2.0 and implications across the market, the winners and the losers, that's been sorted out by the market as we speak right now. The infrastructure AI build out is, as Claire said, underappreciated and has started, and we believe we're 5 minutes into the football match. Then in terms of physical AI, it's one of the applications that sits on top of AI and accelerated computing. So with the internet, you built and monetize through the application layer through software. This time it's just very, very different. And physical AI is one of those ways of applications of AI that can really monetize artificial intelligence. So what are we meaning? So we're meaning first autonomous vehicles, which we now see being rolled out in the US, which is coming to the UK soon. I think Waymo's doing initial testing. I'm sure Tesla full self-driving will be coming soon. I'm crossing my fingers because I've got a Tesla Model Y at home. I can't wait to sort of sit in the back and let it drive me around. But what we're seeing a breakthrough with vision AI. So the technical side that enables humanoid robotics now to be used across the broader economy. And so what we need to do now is to build out the supply chain. So just like electric vehicles, we had the technology, but we need scale manufacturing 10 years ago. The same thing we need for humanoid robotics. Today, we're seeing Optimus from Tesla come out with their Generation 3 product sometime the end of this year or the start of next year. And we expect scaled manufacturing of that to appear sort of 2027, 2028, of around 1 million units annually. And so what that means is when we have the technology breakthrough and then we have scaled manufacturing, then we get that crossover where you get the break even between a human working in an automotive factory being more expensive than a humanoid robot. And so that's when we expect the broad adoption across the economy. And we expect that to happen 2028, 2029, but constrained by the supply chain, just like with electric vehicles and other major technology transitions. You need the supply chain to grow before you can really serve the end market in a meaningful way.
So we've seen some companies come to the debt market, which has caused quite a lot of commentary. What's your view on this?
Yeah, so debt's going to play an important part of this infrastructure build out over the next 10 years. There's no doubt that if you're going to build infrastructure, you want to finance some of that with debt. Otherwise, your weighted average cost of equity goes up significantly if it's all funded by equity. That's an important sort of evolution that we need to sort of to get used to. There's a lot of speculation about Oracle, how it couldn't raise debt in the market, or that it was too far over its skis in terms of the commitments it was making. Went to the market about 3 weeks ago now, raised all the debt that it needs for the next 12 months, and that offering was 5 times oversubscribed. So it shows you almost the divergence between what the media is talking about and market commentators versus what's happening in the real world. And what we're seeing is, because as Claire talked about, the ROI on AI is meaningful, and there's an enormous opportunity set going forward. It means that these companies are not slowing down. We need to finance this build out with a mixture of equity and debt. And we think the best way to frame this is looking at infrastructure across the global economy and think about, how are roads, how are bridges, how are buildings, how are they financed? And we wouldn't be surprised if the mix is sort of either 70-30 or once the technology starts to mature, maybe it's more like 50-50.
Thank you, Claire. Thank you, Storm. And thank you for watching. We'll see you next time.